Most people want results fast. They want quick profits, overnight success, and instant financial freedom. But here is the uncomfortable truth. The people who actually build lasting wealth are not the fastest movers in the room. They are the most patient ones. Financial patience is not a weakness or a passive trait. It is one of the most powerful competitive advantages a person can develop in their lifetime. And the data, the history, and the real stories of the world's wealthiest individuals all point to the same conclusion: patience pays. The hidden power of waiting. Warren Buffett is worth over $100 billion. But here is what most people do not know. 95% of his wealth was built after he turned 65 years old. Buffett started investing at 11. He spent decades making quiet, calculated decisions while others chased trends and panicked during market downturns. He did not become the greatest investor in history by moving fast. He became great by waiting longer than everyone else was willing to wait. This is the foundation of financial patience. It is the willingness to let time do the heavy lifting. Compound interest, the process of earning returns on top of returns, is often called the eighth wonder of the world, and it works best when it is left alone. A person who invests $1,000 at an 8% annual return will have roughly $10,000 in 30 years without touching it. The same person who keeps pulling money out, reinvesting in hot trends, or reacting to market noise will likely end up with far less. Jeff Bezos once asked Buffett why more people do not copy his investment strategy, given how straightforward it appears. Buffett's answer was telling. He said people do not want to get rich slowly. That single sentence captures why financial patience is so rare, and therefore so valuable. Most people compete in the short game. The patient investor wins the long game almost by default, simply because so few people are willing to play it. The financial world constantly tempts people with speed. Social media is flooded with stories of people turning small investments into fortunes overnight. Cryptocurrency made some individuals millionaires in months. Meme stocks like GameStop created a frenzy where regular people made life-changing money in days. But for every person who won in those moments, thousands more lost. The spotlight always finds the winner, never the crowd of people who followed the same strategy and failed. Patience removes a person from that gamble entirely. It replaces luck with probability and emotion with discipline. Why impatience destroys wealth? Impatience has a very real financial cost. Research into investor behavior consistently shows that the average investor earns significantly less than the market itself, not because of bad investments, but because of bad timing. People buy when markets are rising and sell when markets fall. They panic at the wrong moment and celebrate too early. They trade frequently, which generates fees, taxes, and errors. All of this activity, driven by impatience, quietly erodes wealth. Consider the story of Cathie Wood, founder of Ark Invest.
Beyond that, we actually see trillions, because we're not just talking about sequencing human beings.
Rising nearly 200% in a single year. Retail investors poured money in at peak valuations, chasing that performance. When the fund declined sharply over the following years, most of those late investors sold at a loss. The fund itself was performing according to its stated long-term strategy. But the investors who bought in out of excitement and sold out of fear never gave the strategy time to work. Their impatience cost them. Contrast that with the approach of Charlie Munger, Buffett's longtime business partner at Berkshire Hathaway. Munger was famous for saying that the big money is not in the buying and the selling, but in the waiting. He held positions for decades. He ignored quarterly earnings noise. He focused on the fundamental quality of businesses and trusted that time would reward the right decisions. Munger built enormous wealth not by doing more, but by doing less, and doing it with extraordinary patience. Impatience also shows up in spending behavior. Studies in behavioral economics reveal that people consistently choose smaller immediate rewards over larger future rewards, a phenomenon known as hyperbolic discounting. It is the reason people spend impulsively on things they want now instead of saving for things they need later. Every unnecessary purchase made today is a compounding opportunity missed tomorrow. Financial patience, therefore, is not just about investing. It is about building a relationship with money that prioritizes the future over the present. There is also the psychological side of impatience. Markets go through cycles: growth, correction, recession, recovery. Historically, markets have always recovered and moved higher over long periods of time. The patient investor understands this cycle and stays calm. The impatient investor sees a downturn as a disaster and reacts. Ronald Reed, a gas station attendant and janitor from Vermont, died in 2014 with a net worth of $8 million. He never earned a high salary. He simply invested consistently in good companies and never sold. His wealth was not built by brilliance or speed. It was built by patience and time. Building financial patience as a strategy, knowing that patience is powerful, is one thing. Actually practicing it is another. It requires deliberate habit building, a clear financial vision, and the mental discipline to resist the constant pull of urgency. The first step is defining a long-term financial goal. Patience without direction becomes indifference. People who are financially patient are not passive, they are strategic. They know exactly what they are working toward. Whether it is retirement, financial independence, or generational wealth, the goal acts as an anchor. When short-term noise tries to pull them off course, the goal keeps them grounded. The second step is automating financial decisions wherever possible. Warren Buffett endorses low-cost index funds for the average investor precisely because automation removes the emotional decision-making from the process. When contributions happen automatically every month, there is no moment of hesitation, no checking the market, no second guessing. The system does the work while the investor stays patient. The third step is changing the information diet. Watching financial news daily creates a false sense of urgency. Every headline is framed as critical. Every market movement feels significant. But most of it is noise. Successful long-term investors like Buffett famously do not obsess over daily prices.
Graduate schools and business, and they're learning all these complicated formulas and all that.
They focus on business fundamentals and ignore the rest. Limiting exposure to short-term financial media reduces anxiety and strengthens patience. The fourth step is learning from history. Markets have crashed in 1929, 1987, 2000, 2008, and 2020. Each time they eventually recovered. Each time, the patient investor who held through the storm came out ahead. Studying these patterns builds a mental resilience that is hard to shake. When the next downturn arrives, and it will, the historically informed investor stays calm while others panic. Rihanna became a billionaire not just from music, but from her Fenty beauty business. Her team spent years developing the brand before it launched. The patience in building a diverse, inclusive product line before rushing to market was part of what made it explode. Oprah Winfrey spent decades reinvesting in her brand, her production company, and strategic partnerships long before her wealth reached legendary status. These are not people who chased quick returns. They were patient architects of long-term financial power. The world rewards urgency in conversation, but rewards patience in wealth building. Almost every major fortune ever built, whether through business, investing, or creative enterprise, was the result of sustained effort over a long period of time. The stories that get the most attention are the overnight successes, but behind almost every one of them is a much longer, quieter story of patience, persistence, and compounding progress. Financial patience is a competitive advantage because most people will not practice it. They will sell too soon, buy at the wrong time, react to headlines, and let emotion guide decisions. The patient person does none of these things. They stay in the game longer, let their money work harder, and reach their financial goals with far less stress and far greater results. The race to wealth is not won by the fastest runner. It is won by the one who stays on the track the longest. Start early, stay consistent, ignore the noise, and give time the chance to do what it does best. That is not just good financial advice. That is a strategy that has quietly made more millionaires than any hot stock tip ever will.